if you fail to plan, you are planning to fail. So part of this 4-step process is really giving you a clear plan. In terms of getting out, preventing those big losses like we saw on Zip, we can use a stop loss. The stock gets to a price, we'll jump on our broking platform and make sure we get out. You can use an amount-based stop, and this is typically a dollar amount. So it might be, say we got in at 8, we set a stop loss at 7. If the price moves to 10, we might then move our stop loss by a specific amount, or you can use a percentage-based amount. I think that probably works better, especially when you consider a stock like Zip, where $1 at the start of its move is very large compared to $1 at the end of its move. There are a couple of others we'll talk about as we go through the slides, so technical analysis-based and index-based portfolio management. The first one is the amount-based, and I've just used a very simple dollar-based example here, and it just illustrates with the red line how your stop can be initially set and then trailed up at each sort of a trigger price movement. So it's Worley Parsons. We get in there at 10. We set our stop loss at 9. The stock gets to 11. Hey, don't leave your stop loss at 9. We trail it up to 10, whether we do it on a discretionary basis or we get onto a platform and change that in the system. Stock goes to 12, we go to 11 with our stop, and so on and so forth. Eventually, the price comes back to our trailed stop at 14, and we're stopped out. Now, is it possible that Worley goes straight back up to $20 and makes you feel really foolish for getting out at 14? Well, first thing, I don't think you'd be too upset because that was a really nice trade for you. The second thing is there's nothing stopping you from getting back onto Worley Parsons as it goes through 15 or 15.50 through the old high there. So, we have to dispense with this notion that you get one crack at a trade on every stock, and that's it. You can always get back in if your stop loss is hit. The stock continues to go up. Now, this is the second bullet point we had, which was the technical analysis-based stop. And I've used the 50 and 200 period moving averages here because they are super, super popular. The way I like to use these is to say, well, the exit signals are going to occur in various sequences. Okay, it's just maths. The maths of this will kind of ensure these things will happen in this sort of order, where the 50 period moving average will turn down first. We might use that as a catalyst to reduce some of our position. So the other thing is you don't have to be all in and all out. If you've got this all in and all out mentality, it does kind of force you to feel you have to be perfect with your entry and perfect with your exit. If you take this stepped entry and stepped exit strategy that I like to use, then if you get in and the stock falls away, that's not so bad. You didn't put your whole position in. If it goes up, you put more in, that's fine as well. But if you get out of some and the stock keeps going up, you don't feel so bad either. So let's say the 50 period moving average, that's the red line, turns down. That might be your catalyst to exit 1/3. Then the second exit signal there is the close beneath the blue line, the 200 period moving average. And then the final exit signal might be the famous death cross, where the red line 50 period moving average closes beneath the 200 period moving average blue line. So look, in this case on Zip, you would have had, you would have been exiting positions anywhere. It's quite a wide range between sort of $6 and $10, but certainly far better than not having a plan, buy, hold and hope strategy and just getting wiped out completely. So that's the message. At least we've got a plan. Now, this third aspect of having an exit plan is using an index-based portfolio management. Sounds complicated, not that complicated. We use an index, an appropriate index for your portfolio. Now, I've just gone the NASDAQ composite because we started with it. Let's continue on that theme. And I like to use my moving average ribbons, the basics. It's a traffic light system. And you can use your own set of indicators to work something like this out. But the message is, on the way up, my traffic light system says green is go, happy days. You can have, a substantial amount of risk in the market. The corollary of that, of course, is you have very little cash. And let's just say, hypothetically speaking, you might be running at 10% cash levels. Traffic light system, so as the indicators start to turn down, we get into that orange zone, you don't keep buying. So some of your stocks are going to be getting stopped out, no doubt, based upon what the index is doing, but we don't replace those with other stocks. We're happy to build up our cash levels here. We might even start to entertain some short trades. And then we get to the red zone. So that is really stop investing in new companies. Look, there's always stuff that goes up in a bear market, to be fair. So you might still have a little nibble on a few of those, but predominantly we are going to cash. I think that's the key message there, and waiting for the market to improve again before we put our money in. So none of this tells you where to put a stop loss on any individual stock in your portfolio, but it does holistically govern how you manage your portfolio during various phases of the market.